The way that I look at deals is I want to understand my downside risk first, right? Because upside is obviously important, right? But can you live with the downside, right? So that is my first thing that I look at on every deal.
Welcome to Multifamily Insights. I'm your host, John Casman, and I want to thank you for joining us for another great episode. If you are enjoying this show and get some great value for your investing goals, let us hear about it. Leave us an honest rating and review. It helps us, and it also helps other listeners find this show and get the feedback necessary to keep bringing you that value. And if you haven't done so, make sure you hit that follow or subscribe button so you don't miss an episode. Now, today we've got a great show. We're going to be talking to Shane Thomas. They say you're the average of the 5 people you spend the most time with. So if you want to grow as a multifamily investor, you have to spend more time with other multifamily investors. And an easy way to do that is to join our apartment investing mastermind group today. Just go to casmancapital.com and click on the mastermind button. Now, as a part of this group, you'll get access to expert trainings, group coaching calls, industry news and updates, as well as all of our webinars and workshops, including our 3-hour workshop on raising capital. Again, if you want to be around other multifamily investors that can help you scale your portfolio today and grow your network, make sure you're a part of the Apartment Investing Mastermind. Just go to casmancapital.com and click on the mastermind button today. Shane Thomas is a Canadian-born real estate entrepreneur and co-founder of Catalyst Equity Partners, a Texas-based privately held real estate investment firm founded in 2016. Now, Catalyst focuses on the acquisition and management of large value-add multifamily properties in high-growth markets. They currently have over 1,900 units and assets under management valued at around $300 million. Let's welcome to the show, Shane Thomas.
Hey, John, thanks for having me. And thanks for that kind introduction. Hope to add some value to your audience and look forward to the conversation.
Yeah, thank you for coming on, Shane. Listen, I went over your bio and gave the introduction at a very, very high level. Why don't you take 2 minutes and fill in some of those gaps?
Sure, yeah, I would love to. Like you said, based in Houston, Texas right now, but I'm a transplant. So originally, from Toronto, Canada, and then moved to Chicago in 2010, kind of at the depths of the recession. My past, like you mentioned, is in consulting. I was in management consulting, former CPA for 10 years. And then I transitioned to multifamily in 2016, but I had been investing in real estate since 2010. So that's when I started my journey, pivoted to multifamily, which we can kind of get into. Really wanted to scale, and multifamily, the valuations based on NOI resonated with me, kind of being a finance person. And my journey, like many others, I kind of stumbled across syndication. Actually initially my plan was to go and buy my own 15 to 20 unit in Chicago, and I spent 6 to 9 months trying to do that, and kind of blessing in disguise in some ways, where I found syndication and actually started investing in 2015 as an LP in Texas. So that's kind of how I got my feet wet. Kind of got to look, under the hood, if you will, a little bit by investing as an LP, and then met my now business partner in 2016. And, we really didn't have any intent to partner. Or at least, we at that time didn't know we were going to form Catalyst Equity and whatnot. And we ended up doing our first deal in 2017, and then decided to do another deal. And then fast forward to now, we've done, like you said, just under 2,000 units. Our focus is Texas, but primarily Dallas and Houston. And we've done anything from kind of 1960s Class C workforce housing, and our newest deal is a 2015 Class A. Our focus is value add acquisitions. That's our bread and butter. We also have a construction company, and we do that for our own projects as well as for third parties. So yeah, I'm married. We got 3 kids, started my business, and had kids at the same time. So, there's a lot of challenges there, and I'm sure for your audience, I think the biggest takeaway is that, you just gotta balance and move forward.
Yeah, I love it, Shane. I'm going to replay some of what I heard you say, right? So Originally from Toronto, moved to Chicago in the consulting world in 2010. In 2016, made the transition into kind of real estate full time or multifamily investing. But you had started investing around 2010, and you formed your partnership with your partner on Catalyst, starting off first as an LP, forming your partnership, moving to the active side of it. And you've been off and running and operating for the last 8 or 9 years. You got into kind of what you all invest in. I want to dive pretty deep into that. So I'm gonna put a pin in that right now. But I do want to go back to those early days because, for those who either weren't active at that time or don't recall,
Right.
2010 was interesting, right? So at that time I was in Detroit. I was coming off of the economic downturn. I was working at General Motors. So I know for me it was, we had dipped into the low points and the valleys and started to see a little bit of the horizon coming up. So things were starting to pick up. And I know I was starting to get interested in real estate. I myself moved to Chicago from Detroit in 2011. And I wanted to start investing and slowly started investing in 2012. So when you take yourself back there in 2010, you're in Chicago, you're consulting, the economy is, has been completely wiped out and then basically is slowly starting to come around. But it's not quite evident to everyone that it's slowly starting to come around. So tell me about what you saw as an investor, not necessarily just with the job and being being the CPA and being a consultant, but what did you see in the market that made you comfortable to start investing when many people would have said, "Ooh, it looks like a scary time to be an investor"?
Yeah, yeah, no, good question. And I think the one thing that I need to kind of preface is that I started investing in Canada, right? So in
Mm,
2010, 2008, 2009, 2010, it was a little different in Canada. We did not experience the GFC to the extent that Americans did.
yeah.
Obviously the Canadian economy is very kind of tied into the US economy. So things did slow down, but honestly, we had not seen a real estate crisis in Canada for many years. That said, obviously, it was there was opportunity in Canada at that time. So that's when I started. So my portfolio was mainly in Canada. I moved to the US in the late 2010, really for the job. And since 2010, I was just like, hey, look, I knew the economy in the US was weak, right? Like, in fact, the partner that hired me basically said, look, I'm actually laying off a lot of folks, and for some reason I want to hire you, and we'll see how long you last. So that's kind of like how I entered the US and was like, look, I'm on a work visa, and I just put my head down and worked hard. But real estate was always something I looked at, and I was seeing the pricing in places like Chicago, and I compared it to Toronto. They're very similar cities, in different countries. And I was like, wow, I mean, pricing is low, and then anybody I talked to that lived in the US at that time was like, real estate was a bad word, like nobody wanted to get into it and whatnot. So we spent, even though I hadn't aggressively looked at stuff until 2014, 2015, I did spend a lot of time scouring neighborhoods in 2011, 12, 13, trying to buy investment property. And it was just for me personally, kind of, I was just ready more so in 2014, 2015.
I
Yeah,
think it's interesting listening to you share that, right? Because I think oftentimes, you talk to folks and it just sounds like they woke up one day, wanted to get into real estate, went to the MLS, found a property, put the money down and started running, right? And what you're saying is you did start investing in Canada first, right? Which is a little bit of a different market, but it took you 3 years
yeah,
to get comfortable with the US market, Chicago specifically, learning neighborhoods, just driving around. And you had already had some experience. And I think it's important for people to understand that, it's really a marathon. Here you are today with a $300 million plus portfolio, but at that time, it took you 3 years to make that first US investment. So give yourself some grace. If you're not exactly where you want to be today, you haven't built a portfolio that you aspire to build, you haven't even bought a single property, give yourself some grace. You're investing your time, your knowledge, your comfort level. You're doing the things necessary to make it to the next level, right? Now you could be doing more, but on the same note, you can't worry about what you didn't do yesterday. Just figure out what you
yeah.
can do today and what you can do tomorrow. With that in mind, what did get you comfortable? I mean, were you looking at the data? Was it a deal that just landed in your lap? Like, what got you comfortable to pull the trigger on that first US deal?
Yeah, I mean, I honestly, it was just, I looked at a lot of data. I looked at where my first investment was actually in Texas, and at that time, 2014, 2015, just the, migration patterns were already beginning, I mean, to expand significantly down south. I personally was in consulting, so I was traveling to Texas, quite frequently, and so, and I looked at places like Dallas and Houston, and they reminded me of Toronto, which is a fast growing city, when I was a kid in the kind of early 90s, and so looked at a lot of data, looked at where people were moving, looked at, tax, kind of benefits and whatnot. And then I looked at pricing, looked to kind of rent to income ratios. And I was like, based on what I was seeing and based on my experience in Canada, I said, wow, these are great deals. And so that's really what got me comfortable. I mean, look, being a former CPA and accountant, I mean, I'm sure they're, very analytical. And I think I caution everyone, there's just, you want to have the balance between kind of weighing risk and reward and, not having too much analysis paralysis, and so yeah, I mean, that's really what I got comfortable with. And I started investing passively. And then from there, as you get more and more experience, you build your team. And John, going back to a point you made, right? Like I had no intent, 10, 15 years ago that I would have, this type of assets under management that were leading as lead GPs. That was, my goal in 2013, 14 was like get to, 50 units, and, in the next 15 years, and that was it, and wrote that down, and I had a plan, and then things evolve, and so yeah, I just think that taking action is important, but not blind action, and so surrounding yourself, I think, it's cliche, but a team is super important, especially when you're moving from, hey, I'm buying, $100,000 single family home to multi-million-dollar commercial property with likely other people's money, right? I mean, it's a different dynamic, and you want to make sure that you got the team and the experience to kind of lean on, and that's where my partnership with my partner, and now we've got, different co-GPs and whatnot. I think, yeah, and we go from there. And then, I think real estate is, oftentimes when you think of it from a single family perspective, you think mom and pop and do it on the side, buy and hold. But then once we got into it, we were like, look, we have to scale, we have to make investments in our company to be a real business, right? And so, and those were all, there's like these inflection points you go through in life and in business, right? And so, I remember the, first 3 years from 2016 to 2019, I mean, we wore every single hat, right? From, the CEO hat of our company to like admin and everything in between, right? And then we were like, okay, there's only two of us and so many hours in the day. And we had to make our first investment in, an admin. And then, now we've got a team of 8 people full time. That's not including, we don't do property management in-house. And yeah, so, and I think, those inflection points are key, and having people to lean on at those points, is key.
One of the things I picked up from you, what you just talked about, was what got you comfortable investing was really having a frame of reference to what was familiar. And I think that's really interesting because we can look at all the data in the world, but if you can't interpret that data, you're not going to be comfortable taking action. And you coming from Toronto, obviously a large international city, when you looked at Chicago, when you looked at some of these different markets, you could see the similarities, and you can also kind of backtrack what the data looked like then, and also what it led to. So when you saw how much the migration patterns had changed when you started investing in Texas, or at least when you were researching investing in Texas, you saw that was coming, but you also were seeing it through your job, right? You were traveling to Texas for work. You were seeing the growth that some of these companies were having. You could read, the articles and all of these different things. So it backed up what you were seeing. And sometimes we have to pair that data with the emotional side of it, right? What we see. And that science is one thing, but if you only make decisions based off the data, you probably would never make an investment. So you do
Right.
have to pair that with kind of what you're seeing intuitively, have the numbers to back it up, and then have that frame of reference. Oh, this is similar to what I saw in Chicago, or this is similar to what I saw in Detroit. Or, when you're looking at those patterns, it does get you a little bit more comfortable. So if you are looking to invest in a city and it's not your home city or you've never been there, definitely try to look at, go visit and compare it to where you have been. Try to get a
Yep.
read for, okay, this part of town reminds me of this part of town. I know
Right.
that's what got me comfortable when I was investing in Cincinnati, coming from Chicago, is I started to figure out, okay, this is where all the growth and development's happening.
Right.
This is where the coffee shops are. This is where the nightlife is. This is where all the new restaurant developments are taking place. Obviously, a much smaller city, but when you can tap in with that local market knowledge, you can identify the path of progress. You can then say whether you invest directly there or in the surrounding areas to say, okay, where would I expect that growth to happen next? And what's driving that, right? What's the catalyst? What's in between? That's how you can get really comfortable making that first investment. The second
Yeah.
part, you got into more of what you all do, which again, we're gonna come back right there. But I like the fact that you mentioned you started as an LP and kind of went on this trajectory where you got comfortable invested as an LP, ultimately ended up launching your own partnership to launch Catalyst, and then the growth trajectory of Catalyst. Before we talk more about Catalyst, when you reflect back, what questions did you ask of that initial partnership team that you invested in? And would you do anything different looking back from that first LP investment?
Yeah. No, that's a great question. I mean, I think obviously there's a lot of questions that you can ask, right? I mean, back then, I was getting into it. So, I don't, hindsight's 2020, right? At that point in time, I was saying, okay, you know, what are who are the GPs? What are the roles? I think like that's very important, right? Understanding who the management companies were, what the business plan was, right? But I think the key is getting educated, right? So what I spent a lot of time doing was like understanding, okay, multifamily, large multifamily, how does it work? What are some rules of thumb, right? And so I just, based on that education, I asked as many questions as I can about the particular deal. But then I spent a lot of time, on the jockey, right? Like in terms of like who's running that actual deal. I think looking back, what and look, I did this with a full-time job for a couple deals, but I think you know really understanding the roles and responsibilities better would have been something I would clarify going forward, right? Because a couple of the deals that I invested in, it just really wasn't clear. I think there was a lot of excitement pre-deal, like acquisition, that we're buying this deal. And then I always say, like, asset management is 80 to 90% of a deal life cycle, right? It takes 3-4 months to buy a deal, it takes 3-4 months to sell a deal, but you're in it for like 60 months. At least that's what the business plan is. And so that's where, I think on a couple of my first deals, there was a lack of alignment within the co-GP teams. So those are questions that I ask right now. And, quite frankly, right now, I'm making sure that if they're not full time, like, do they really have a team that can execute this properly? So that's really what I focus on. And now my criteria is more clear. Back then, I was just like, I wanted to deploy capital and kind of preserve capital, grow my capital, et cetera. Now I'm like very clear, like, I'm an investor in all my deals in Texas. So now, generally I'm trying to invest outside of Texas as an LP, just to diversify. I'm more of a growth investor versus a cash flow investor, so I think that's all kind of individual, based on their goals and where they are in life.
Yeah, I appreciate that. I think it's important too, especially for those investors looking to start off, because you're not going to know the right questions. I mean, you can listen to every podcast we have, and I know some folks put together a list of questions to ask. But if you don't know why you're asking those questions, you don't know how much weight to put on the
Right.
question, and no one's perfect, right? You're
Yeah.
not going to find the perfect investment, the perfect operator.
Yeah.
So what you're trying to do is mitigate your risk, and as you stated, bet on the people, bet on the right team, make sure that their roles What they're going to be delivering is really clear. They know exactly what they're doing. They have the experience, the track record. That's what you're really banking on. So I appreciate you sharing that information, but also how it's evolved for you as an investor, right? Getting clear on what you really want, knowing that your primary investments are in Texas. So when you invest as an LP, you want to get some diversification outside of the Texas market, but you also know more focused on growth investment opportunities as opposed to simply cash flow opportunities. So really important to know what your goals are as an investor. That's going to allow you to make better decisions and ask better questions for who and what deals you invest in. Let's talk more about catalysts, right? At what point did you realize or decide that you wanted to be more on the general partnership side as opposed to just sticking to being an LP?
Yeah, no, it's a good question. So I had done a handful of LP investments, kind of I think the benefit there, like I mentioned, is you kind of see a little bit under the hood. There's a lot of things I was like, great, these are great things to take away if I was ever to become a GP. And then there was things that you learn from, right? Like, okay, I'm not gonna do these things, right? And then as I think it was probably 1.5 years into my LP investments, I was getting more and more ingrained in syndication. And like I said, my path was, or at least my goal a couple years prior was to go buy my own multifamily, right? More from a buy and hold on to it, refi, et cetera. And then, the more and more I was seeing kind of the results of my LP investments, the more and more I saw that, hey, I think I have a lot of the background, right, to be able to do this. And so it just kind of, that those experiences helped me say, hey, I think with my background, I don't have it all figured out, but I have a lot of the, kind of characteristics to be able to lead these efforts, and then I just surrounded myself with, kind of going to networking events and whatnot and meeting folks. And I met my now business partner, and we have, it's been 8 years, and, we have the same, similar vision and ethics and complementary skills, right? I mean, he had run his a business for, a long while and had a lot of kind of operational experience. I had a lot of kind of consulting finance experience. And so yeah, we just decided like, hey, let's go do one deal, right? And we'll see how that goes, right? And so yeah, and then from there one became two, and then we kind of moved on from there. So but yeah, that's kind of how we got started. Just put one foot in front of the other. So
I love it too. And the thing that stands out to me is like, as you stated earlier, like you don't really know where it's going to take you, right? But you just got to get in the game. And you start as an LP to solve your own personal financial issues. You wanted to get in there, get some cash flow, get some appreciation, right? And that's what you did. And as you got into it, you learned more about the operations. And then you mentioned that, with your background, you felt like this is something you could do. Can
yeah.
you elaborate a little bit more on maybe the characteristics or the skills that it takes to be a good syndicator or a good operator?
Yeah, no, that's a great question. And I think, I mean, there's a lot to unpack there. I would say, you know, it would be hard for any one person, in my opinion, to be able to be kind of wear all hats. So I think, if I had to kind of summarize, I think there's kind of probably three or four main areas, of skill sets, right? And so, one would be kind of the, you know, deal acquisition, underwriting, due diligence, right? Like you need somebody that can really kind of understand numbers, and it's not just putting numbers in a spreadsheet, but be able to articulate and describe the story, right? Like how it all comes together. I think you need someone that has a lot of operations experience, right? Post acquisitions. How are we gonna, whether you're managing yourself or not, how are we gonna manage the management company? How are we gonna execute? People that have good project management experience, in corporate lives, those translate well, right? So I did a lot of PM work previously. So that's kind of one skill set. I think construction, you don't need to, honestly, I'm not handy myself, right? But knowing enough to be dangerous there, right? There's different vendors, contract negotiation, right? Like that is a skill set, right? So I think that's one area. And then, you need, kind of marketing, sales and marketing, right? I mean, you need to get investors. You need to be able to stand out and differentiate yourself when you're raising capital. And, the communications and the customer service, I think, is one of the things that, we look at very, very seriously, and a lot of, syndicators, at least when I started in the space, weren't, right. There's a lot more margin for error back, 8 years ago, right? Things have changed right now. There's a lot more competition, margins are thinner. But servicing your customers and your investors, right? Like we give out reports every single month without fail. We communicate good news and bad news, right? So anyway, so those are like the 3 or 4 areas I would say you need, and generally I would say, between 2 to 3 people, at least strong lead GPs, you could cover most bases, and then you'll have your external vendors to kind of augment. I think what I would, caution folks in general, and I've seen some of them be successful, is that you don't want too many cooks in the kitchen, right? And so I think there's a balance between like having too few, right? If you only had one person and, God forbid something happened, the lack of continuity is concerning, but you don't want a football team worth of people, trying to manage these deals either. So I think there's something in the middle there, and every deal, every situation is unique, but that's kind of how I view it.
Yeah, I love that, Shane. I mean, my takeaway from what you said is you want to have the right mix of skill set. And we hear people say all the time that this is a team sport. You just gave a great example of what we're talking about when you hear that, right? It's very rare that one person has all of those skills. And even if they do, it's still too much work for one person to do. So when it comes to, the acquisition, due diligence, underwriting, the operations, the construction, the marketing and sales, the customer service, the investor relations, you're going to need people who can wear hats. Even if you're starting out, you may wear three of those hats. Maybe someone else is wearing two or three of those hats, but you got to have not just different people, but complementary skills to make sure you're covering the important things. The other thing you talked about was make sure it's not too many cooks in the kitchen, right? It's really hard to make a decision when 8 people have to weigh in on it. So make sure you understand who's making what decisions, which individuals have the expertise to weigh in and kind of lead that decision making process, because some folks may be informed about certain things, whereas other topics or other decisions, they may be the key decision maker. So it really depends on the knowledge and expertise level, and making sure you build an organization, which again, just like any other company, right? When you're putting together that marketing plan, that's going to be run up through the CMO. You're not going to go, I mean, the finance guy has to have some input because he's given the budget. Uh, but that's it, right? He's looking at more from a financial standpoint and budgetary standpoint. You're not going to let the finance guy decide whether or not your logo should be blue or green. So
Right.
just really important to make sure you have the right people making those decisions. One of the things you were hitting on earlier, I want to come back to, right? So we talked about kind of catalysts and kind of how you're able to grow and scale. You mentioned right now you are focused on the Texas market. I know most of your properties are in the Dallas and Houston markets. You mentioned that you have some assets that are, 1960s vintage, some that are 2015 vintage. That feels like a very wide range of assets. And I don't know if there's a certain unit mix or what other parameters you use. But you mentioned that you always are looking for value add deals. One, how do you define value add deals? And then two, how are you able to look at such different vintages and put together the right business plans for that vintage? Whereas, I know a lot of groups would say, hey, we only buy stuff built in 1995 to 2005 and 200 plus units, right? So yours seems a little more flexible. So I just like for you to explain kind of how you approach your deal criteria.
Yeah, yeah, no, happy to. So I think first things first. I mean, if you talk to any broker, every deal is value add, right? That is you got to take that with a grain of salt. But I mean, I think the way I would say is we cut our teeth, on the older vintage stuff, right? When you're starting off in the business, generally, you kind of start off in the older vintage stuff. I mean, it's more for private capital guys versus institutional. But that wasn't the only reason. The reality is that, we kind of looked at from risk adjusted returns perspective, right? When I started in the business, class C assets were trading for 7 to 9 cap. Like my first deal I bought at a 9 cap in 2017 or late 2016, when class A deals were 5.5 to 6, maybe at that time, right? So at that time, we thought, hey, we were getting enough reward to take on that risk, and it made sense. So we did our first 5 or 6 deals were all 1960s, 1970s vintage. And we were able to, at least pencil to returns that our investors needed, to get excited about a deal. So we pivoted more so towards newer vintage stuff post COVID, right? When cap rates compressed, right? So I think a lot of folks, if they've been listening to your show, I'm sure they've kind of heard this narrative, And so when cap rates compressed, Class C deals were getting pretty much priced the same as Class A deals, right? Everything was a pro forma buy, and we were like, you know what? Now it starts making more sense to buy less risky deals, and get similar returns. And so that's when we pivoted. And then now, as cap rates have kind of, I would say, gapped out, meaning, the older stuff has now started to decompress, we're seeing cap rates, for C stuff kind of with a 7 handle now in Texas, which we haven't seen since pre-COVID, right? And so now, and Class A seems to be kind of plateauing at like 5.25, 5.5. They were as low as sub 4 at one point. And so now we're feeling like risk is getting repriced. And so now we'll go back and start looking at older deals, right? So it's really been kind of an evolution of kind of just the market dynamics. And that's how we've kind of, modified our criteria, based on that, our box, is generally, good locations in high growth markets. And how I define value add is real value add, right? Like, we know that a lot of deals have been traded, 5 times in the last, 15 years, right? And so, like, is there real value add remaining or not? Meaning, a lot of the deals that we've purchased have been owned for 10, 15 years, right? And so with that type of ownership, generally you'll see more meat on the bone, right? They've not invested into the property like the properties that have been flipped like hot potatoes, there's true in-place differential between rents, right? Or, maybe they're not using a professional management company or their mom and pop, et cetera. So we're really looking for true value add. I think most of the value add in today's market is generally with income. Expenses, as we all know, have risen. I mean, it's really hard to, in my opinion, to cut expenses in a meaningful way. There have been deals that we've done that, but you don't want to starve deals, and so yeah, I mean, I think we really focus on rents, other income, and just being realistic, and we focus on basis, right? I think one of the things you cannot change is the price you pay, right? You can always change your financing and whatnot, but basis is very important to us, and and where we can take the deal, right? Like, I buy the deal at X today, but what am I going to take it to in 24 months, 36 months from now, and whatnot. So yeah, we've done a mix of bridge loans and fixed rate loans. So kind of all of the above.
Shane, I love what you said, and it's refreshing just to hear some of that because, one thing that newer investors may not realize is, there was a time period where you got rewarded for buying those C-class properties, right? Those were trading at 8 caps, 9 caps. And again, taking out some of the terminology, right? All we're saying is that, you would buy that property and the cash flow would be a 9% return based on the NOI. So if you're buying that at a 9 cap, there's more inherent risk is what the market is saying. So you're going to get better profits. And what happened over, maybe 3 or 4 year period is that return got compressed to the point where the returns were pretty much identical to buying an A-class property. So what you did and what many others figured out and started doing is like, well, why would I buy a 1960s property at a 6% cap rate to get a 6% return when I could buy a brand new property or a relatively newer property and get a 5 or 5.25% return? Like, give me the newer asset instead, right? So now we're starting to see that decompress and change where there is a bigger gap. So now there is more value or upside in some of those older properties where maybe there wasn't for the last 2 or 3 years. So I appreciate you breaking that down the way you did. The other thing I would say for our listeners is it's also important to figure out your own deal criteria. Don't just listen to Shane or me or whoever else. This is one of the mistakes I made is I was trying to make my deal criteria what other people are using, and it didn't work in my market. Those properties didn't exist in my market, but it also just didn't make sense in that market. So your criteria should be based on the market, but then also your skill set. You have the ability, you got the construction team, the background there to go buy a 1960s property, recognize what that property is going to need from a plumbing standpoint, HVAC, electrical, roofing, and be able to address that and take that on. Some groups may not have that experience, right? So when you're putting your deal criteria, make sure you pair that up with your team and the skills, and make sure the team is actually prepared and capable of taking on an asset like that and running the business plan. Hey, last question before we kind of transition to our round of insights. As you talked about kind of the market, and you mentioned a little bit about using some bridge loans and some fixed rate loans, just give me kind of the philosophy when you're putting together a plan, a business plan for a deal. What are the key things you look at? Do you have any red flags, things that are automatic no's or out? Or, are there things that you look for and automatically you're in? Just give us a little bit more about, that due diligence and kind of your acquisition process and what you really look for today.
Yeah. No, that's a great question. I would say the way that I look at deals is I want to understand my downside risk first, right? Because upside is obviously important, right? But can you live with the downside, right? So that is my first thing that I look at on every deal. And then, how that kind of plays in together with the decision making process is like, location is very important, right? Because I believe, I can go and change a property and fix it up, right? So I'll buy a class C property in a B location, but not vice versa, right? Because I don't think I can change an entire location. So location is very important to me. I always think about what's my exit, because sometimes a lot of people say, oh, it's too competitive, this deal, blah, blah, blah. But oftentimes you got to think about it when you go to sell this property, it's likely going to be competitive too, because people want it. What, right? Is it liquid, right? Sometimes you'll see these deals that are like off market, tertiary markets. The returns on paper may look good, but it's not liquid, right? So I think about, it's one thing getting into a deal, but it's also how am I going to get out? Know your exit strategy. So those are kind of the big broad picture stuff. And then start diving into, more, the deal, the mechanics, the true value add potential, sensitivity analysis. If I don't hit my rents, I think one important thing that many of us, whether you've been in the business 20 years or 5 years or 2 years, is debt, very important in the commercial space. We do have the benefit in multifamily to have the backing of the, Freddie and Fannie, right? Which a lot of other asset classes don't have. That said, you have to match your debt with your business plan, right? I think, a lot of people, are like, oh, bridge loans are bad, but I don't necessarily agree with that. I mean, I don't agree with that at all. I think you have to use the right tools for the right deal. And when they get misused, that's when you run into problems, right? So like I had a deal where I had a fixed rate loan for 12 years and sounds great, because I didn't have any maturity risk or whatnot, but I couldn't sell the deal, when the market was at its peak. I had like a $12 million loan with a $4 million prepayment penalty, right? I was handcuffed to the deal. And so I think it's just, understanding that strategy. But yeah, it all begins with downside risk. That's how we look at it. Very focused on location, exit, liquidity, and then we get dial into the kind of different metrics from there.
Yeah, Shane, I love it. I appreciate you breaking that down and sharing that, especially the example on, fixed rate. Like it sounds great on paper, and there's obviously a lot of value in that, but you do need to match the business plan to the loan product you select. And ultimately, it still comes down to execution, right?
Yeah.
So wherever there's risk, you've got to make sure you can execute and then kind of put everything in your favor to be successful. Shane, if folks want to learn more, they can check you out and go to your website, catequity.com is the company's website. I'll make sure we link to that in the show notes. Right now, we're going to transition to a round of insights. All right, Shane, give me a failure or an apparent failure that set you up for later success.
Yeah, I mean, I think, every day we're learning, and so I would say related to the business, I would say on my first couple deals, we did not capitalize the deals as well as we should have, right? And so I learned that lesson from the beginning. And now all of our deals, we make sure that we overcapitalize our deals, even if it means diluting returns on paper, right? I think, investors, especially in this market, are seeing that, right? And so we overcapitalize our deals and make sure that, all the as many worst case scenarios as possible are handled or accounted for. So that's kind of one of the things that we learned, right from the get go.
Give me a digital or mobile resource you recommend for investors.
So I would say, we use a lot of collaboration tools, so like Slack is something that we use with our team, Asana for project management, but yeah, I mean, I'm pretty much, tethered to those communication tools. I mean, we use a lot of other tools as well, but like Slack, I think is one of the, it's the one that we use the most. Even though we're a remote team, where everyone's available on that, we could collaborate. It's minimized email significantly, right? The only time we send out an email is when it's an external vendor. And so, yeah, so that's, outside of, the other tools that we use, specific to real estate, I think Slack has been one of the best.
Give me the book you've recommended or gifted the most in the last year.
I would say Who Not How by Dan Sullivan. So that book, is the concept is very simple when you think about it, but it's been a game changer for me personally and in business.
Give me a daily habit that helps you stay focused on your goals.
So every day I write down 3 things that I want to accomplish that day, right? We all have to-do lists. I've got one with like 25 things on it, but like I just say, these are the top 3 things I need to get done. And then anything above that is bonus. And then I make sure that I work out, 3 to 4 times a week consistently without fail. And give myself a lot of time in the mornings. I'm a morning person, so yeah, those kind of 3 things is kind of how my daily habit.
Give me your number one insight for scaling a multifamily investing firm.
I would say, it may sound scary at first when you think about like, hey, I'm just starting a business and I got my first couple deals, and you're like, thinking about, hey, I need more time. I would say the biggest insight I have is hire, as fast as you can to alleviate a lot of the burden on you, so you could focus on the most, highest rewarding, ROI tasks. And it's easier said than done. But I think there's a lot of tools and resources. Like when we started, we had a virtual assistant or a couple of virtual assistants and whatnot. So they're low risk, low cost options for you to start. But that's the key to scaling, right? You have to be able to delegate, find good people to be in the right seats. So that's the key. We wouldn't have been able to scale to where we are now without having the team behind us. And if I look back, that's probably one of the biggest learnings I have is I wish I would have hired sooner.
Shane, you're in Houston. Give us your favorite place to grab a bite to eat.
Man, so Houston is pretty much, known for its food. There's a lot of places. We're into sushi, so I would say probably Uchi. There's a nice restaurant called Uchi downtown Houston that I would recommend.
All right, it's on the list there. Shane, really appreciate your time today and just learn a little bit more about your story coming from Toronto, moving to Chicago in the consulting world, starting to invest while you were in Canada, and then learning about investing, not really finding that first deal in Chicago, but also investing as an LP in Texas, transitioning from the LP side to the GP side, recognizing that with your background, you actually had the skill set and you had a partner that you worked with. And I think this is just a great insight. We always hear this as a team sport. Be willing to work with others, be willing to partner with other people. And that's going to give you a chance to move forward through that partnership. You and your guys were able to grow and build this portfolio, $300 million worth of apartments, and just sharing what you're doing today, how you approach the market, why you can buy a 1960s asset and a 2015's asset, right? Is really getting into the business plan. And I particularly love the focus on the business plan and pairing the right loan product with the business plan, as opposed to just these hard, fast rules of no bridge loans or no this, no that. Just find the right opportunities that make sense based on the returns you're looking for and your market knowledge. So love those insights, and I know it's very helpful for a lot of our listeners. Again, for folks that do want to learn more, they can check out your company's website at catequity.com. Again, that's catequity.com. Shane, thanks for being a great guest and coming on Multifamily Insights. We look forward to staying in touch with you, and I hope you have a great day.